So basically, corporate governance is about all kinds of mechanisms that will try to, analyzes the relationship between different stakeholders in the company and how stakeholders, at least CEOs and debt holders, work on behalf of the company. So this is the Wikipedia definition. And basically, we will try to use corporate governance systems to decrease any kind of conflicts of interest between stakeholders. And from there, we will hope that having a better corporate governance system will translate into having a better company, which means increased firm performance. So when I say stakeholders, this is a slide you probably remember from my other class. There are different stakeholders in the company. So those agents are the agents that have some kind of stake in the company. So we have the shareholders, stockholders, equity holders. These are the owners of the company. They have the voting rights. And then we have managers, CEOs, and board of directors. These are the people who manage the company. Then we have debt holders who lend money to the company. We have society, government, and regulators. We have employees, we have suppliers, we have customers. So all those agents affect how a company is managed, basically. So if we want to look at what kind of role those stakeholders play and what should happen in an ideal world and what happens in real world, I have this slide. So basically, we assume that the goal of a corporation is to maximize value. And when I say value, we're talking about maximizing what? What value? What?
Market.
Market value. It's the value to whom? Which stakeholders? Shareholders, exactly. So if you think about the balance sheet, on the left-hand side, we have the assets. On the right-hand side, we have debt and equity. So maximizing the value of the company means maximizing the value of the assets. And when I say assets, it has assets in place, so what the company already owns, also growth opportunities of the company. So if you, again, remember from the corporate finance class, you also calculate present value of growth opportunities, so your expectations about the future. So on the right-hand side, we have debt and equity. You can increase debt to increase the value of the company, and we talk about the good things about debt, which is what? If you increase debt, you enjoy tax benefits. You increase your interest tax shield. Perfect. How this happens? You decrease your taxable income because of the interest payments, so you pay less tax to the government. Then we have the equity part in the balance sheet. So, increasing debt also means increasing something bad, which is what? If you increase debt, you increase financial distress, the probability of bankruptcy, which is a bad thing. So you cannot simply increase the value of the firm by increasing debt in a world where there's bankruptcy, and in real world we have bankruptcy. So we are focusing on equity part, but we are not interested in book value of equity, but we're interested in market value of equity. Why? When we calculate what? Okay.
We are using market value.
Oh, WACC. Okay, yes. Okay, yes. But more importantly, there was something else. What is the difference between book value and market value? Yeah, book value is all about backward looking. It's about the equity value that was issued in the past. But since we are interested in the value of the company overall, the value of the company is determined by past, present, and future. So to incorporate the future expectations about the company, we need to look at the market value of equity, which is calculated as price times numbers of shares outstanding, and price has information about the future as well. Okay, so in this world, what stockholders want? Stockholders, of course, want the managers to work on behalf of them. So stockholders, in an ideal world, can hire and fire managers, and managers work on behalf of stockholders in an ideal world. Then, for the debt holders, they lend money to the company, hoping that the company or the manager is going to use that money for good investments. Again, in an ideal world. Then, if you look at financial markets, we want to see financial markets to be efficient, which means what? What is market efficiency? Do you remember it from old times? Which was prices. There are three kinds of market efficiency: weak, semi-strong, and strong. And efficiency overall means what? Markets are efficient. What does it mean?
Stock price get all information. Show all, make all.
Reflect all information. Okay, so basically we believe that if markets are efficient, all stock prices reflect the true value of the firm. And when there's new information related to company, this new news is incorporated in the price of the company immediately. Okay, so if there is any information about the value of the company, once it becomes public, the new prices should reflect that new information. And then again, in ideal world, we believe that managers reveal information honestly and on time. Okay? Society, we believe that in an ideal world, managerial decisions have no social cost. What does social cost mean? Can you have an example? What is the social cost of having a company, a big company?
Like environmental damage.
Exactly, like pollution, like traffic. These are social costs. So in an ideal world, firms don't create any social cost. Even if they do, the cost can be traced to the firm. So from this picture, there are lots of things that can go wrong. What is the first thing? Stockholders don't have much control over managers, unfortunately. And managers might put their own interests on above stockholders' interests. And we're going to talk about the examples on it later. Debt holders, they lend money to the company, but managers have more information about the project specifics. In that case, debt holders can get ripped off. Financial markets, especially if you think about Turkish markets, it's definitely not efficient. But US markets, which is older, let's say, and there's more information about US markets, it is more efficient. But even in a world, even in the US world, we saw examples of market inefficiencies. Can you think of any examples of market inefficiency? So prices were not reflecting the true value of the companies, for instance.
Still house bubble now?
Exactly. No, I didn't hear what you said. He's exactly right. So we have the dot-com bubble. We have the real estate bubble in US. So if markets were really efficient, we shouldn't see any kind of bubbles, because bubble means those assets, whatever the assets in question, was overvalued. It was just like a soap bubble. The value increased. It came to a point where it couldn't hold it anymore, and it burst. So markets are not that efficient, actually. And markets might overreact to information releases as well. Like in the earnings announcements, for instance, if there's positive earnings announcement, it's a good thing about the value of the company. You expect better things about the company. So it is not surprising to see the price to increase, right? Because there was a positive earnings surprise. The company did better than you expected to do. And in that case, yes, there should be a stock price reaction, but then things should settle. But studies show that after those announcements, stock prices continue to increase for a long time, which is also an example of markets overreacting to some kind of information. Another thing is whenever, so in an ideal world, we said managers report all the information honestly and on time. In real world, they really time when they're going to give bad news to the people. And I don't know whether I said this in this class, but studies show that when there's bad information, it is better for the managers to give all the bad information all at once, instead of giving some bad information, wait another week, and give something else, just like ripping the Band-Aid. They should do it very quickly. And then the society part, of course, managerial decisions have very important social costs. You probably remember the BP oil spill. It happened in the US when I was there. And some costs cannot be traced to firms. So there's pollution. It's not very easy to measure which factory is creating what kind of pollution, let's say, if there are lots of companies in that area, for instance. So, but as customers, what we can do, we can react if we think a company is polluting the air, for instance. Like after the BP oil spill, most of my friends said, we're not buying any gas from BP anymore. So customer responsibility is really important in cases like that. Okay. So before going into problems between stakeholders, I will introduce you the theory between those conflicts of interest. We call those agency problems. And in agency problems, we have a principal and we have an agent. So easiest example is probably me hiring a real estate agent and I want her to sell my house. So in that case, I'm the principal and I'm hiring that real estate person. She's my agent. So what kind of conflicts of interest might arise? I want to sell my house at the highest price possible. And let's say I'm not in a hurry. And the real estate agent is going to get some fee, some percentage when she makes the deal. The problem with this picture is that for the real estate agent, in order to sell my house, she has to put lots of time and effort. Like she has to put advertisements. Let's say in US they do open houses, they bake cookies and stuff. You know, they really do things, and they have to call all the potential other real estate agents. Let's say, so it takes lots of time for her. So for the real estate agent, she wants to sell the house as quickly as possible because she doesn't want to spend another week for the sale. Let's say. So in that case, we have a conflict of interest. So this idea will translate into the corporations world as well. And today, I'm going to focus on the problems between actually CEOs and shareholders a lot. This is what the literature does. There are lots of corporate governance papers. I think in 2006, when you Google the corporate governance papers, there were like almost 1,000 academic papers on corporate governance. So it was a very hot-ish topic. And most of them focus on the problems between CEOs and shareholders. And we're going to talk about it later. Another problem might arise between CEOs and shareholders versus the debt holders. So we can take CEOs and shareholders together in that case. The manager is working on behalf of shareholders, but they are against the debt holders. They want to rip off the debt holders, let's say. And the last one is the problems between CEOs and external investors. It might be the product markets, analysts, I don't know, suppliers, customers, any kind of stakeholders. And all those problems actually arise from separation of ownership and control. So easiest example to understand is shareholders are the owners of the company, but since there's separation of ownership and managers, they cannot manage the company. They're hiring CEOs to manage the company. So the manager is not the owner of the company. In that case, the interest of the shareholders and CEOs might be different. And when we talk about options, we actually took it in a different level, and we said debt holders own the company, and shareholders are actually shareholders are like the agents in the company. And we also talk about the problems that might arise in that topic as well. Okay, so let's look at this example where we have stockholders and debt holders. As I just said, in this relationship, we can take debt holders as the principals. They lend money to shareholders and managers are agents at that case, in that case. And in that case, stockholders kind of like have a call option where the exercise price is the debt that has to be paid back to debt holders. And, the value underlying asset is the company value actually. In that case, what debt holders want? Debt holders want safety. They want to get their money back. For shareholders, they care about the upside potential. So if the company makes more than the debt that has to be paid back to debt holders, then shareholders are happy, right? So they're going to exercise the option. If the company cannot produce enough money to pay off the debt, then the company will be in bankrupt, let's say. So in this world, maximizing stock return or making shareholders happy might hurt debt holders. And for this, I give this example where we have two projects. One is project A. It pays $111 for sure. Project B pays either $90 or $115. And the firm is borrowing $100 at 10%, which means the company has to pay back $110 to debt holders. And the cost of the projects are same. So in an example like this, which project do you think debt holders will prefer? They're going to prefer A for sure. Why? They're getting their money back for sure, $110, and equity holders will get $1. But which project do you think shareholders will B. It is risk. We all agree that project B is riskier, right? There's more uncertainty. Equity holders will prefer project B. Why? Because expected gain they're going to get from project B will be 2.5 versus $1 from project A. So as you can see, debt holders want the safe project. They don't like risk. Shareholders, on the other hand, they're okay with risk, and they would go after the risky project. So we call this risk-shifting behavior, increasing the riskiness of the company. And it is because the call option characteristics of stockholders, like let's say, stockholders own call option on the company. And if uncertainty increases, the value of call option increases. And this is what we see here. So it is one problem between shareholders and debt holders, risk shifting, increased risk. Another thing is increasing dividends significantly. Would debt holders be okay with increased dividends? Huh? No? Yes. Debt holders don't want dividend payments. Why? They're not getting dividend payments, first of all. Stockholders are getting the dividend payments. But if the company, which one is better? The company keeping cash so that they can pay their debt later, or that company paying off dividends? For debt holders, of course, cash is better than dividends. So debt holders will want dividend, no dividends. Shareholders will want dividend payments. So that's another problem. And then the third problem that might arise is borrowing more on the same assets. So if lenders don't protect themselves, then the managers can borrow money on the same collateral over and over again. In that case, the riskiness of debt will increase, and the probability of debt holders getting their money back will decrease. So that might create a problem between shareholders and debt holders. Okay, so if we have those problems, what can debt holders do to protect themselves? What do you think? Yes?
They can use like some covenants or...
Perfect answer. Exactly. So when there's a debt agreement, there's a debt agreement between the manager, between the company and the debt holders, right? And it's a negotiation process. Debt holders can tell the company what the clauses are, right? So they can say, don't spend lots of money. They literally say your capital expenditure cannot be more than $250,000, let's say. They're like this explicitly written clauses in the debt agreements. They can restrict leverage. They can say your leverage ratio cannot be higher than 0.18, for instance. Or they can write things like you cannot pay dividends next period. So they can control what the manager can do. Of course, who is better informed? The manager is better informed. Even if they decrease the capital expenditure spending, they might still invest in riskier projects. Of course, the manager knows more about the riskiness of a project compared to a bank manager. Okay? So it might still be a problem. Another thing they can do is they can do secured debt. They might ask for collaterals. So if the CEO cannot pay off the debt back, then those collaterals are liquidated and the money is paid to debt holders. They can use convertible debt, where they can convert some kind of debt into equity later. So they become equity holders when they want. So the conflicts of interest between shareholders and debt holders will be reduced in that case. And Another thing is there are poison puts on the clauses, on the debt agreements, where if a covenant is failed to be, if a company cannot meet a covenant, then control will be transferred to debt holders, so they can manage the company, literally. So that's a very important thing that protects debt holders. And the last one is reputation, of course. In that case, debt holders don't even have to do anything. If there's a CEO who is taking debt and not paying the debt back or using the debt for bad investments, then of course it will be difficult for the CEO to find money in the future. So reputation of the CEO of the firm is also very important. Okay, any questions about the problems between shareholders and debt holders? No? Okay. Then we can move to the problem between managers and shareholders. So here, again, we have this agency problem because of separation of control and ownership. Shareholders own the company, they have the voting right, managers manage the company, and board of directors' role is to oversee the manager. So they have to check whether the manager is acting on behalf of shareholders or not. Okay, but the problem with managers are they have very interesting interests. And actually, in the slides, I put big CEO scandals in the last years. It is really ridiculous, actually. So the easiest example is when you hire, let's say you are hiring the CEO, you're not, but let's say as shareholders, we're hiring the CEO. You don't know what the CEO is doing at this time. So like we are now here, let's say we own shares in the company of, I don't know, give me an example of a CEO. The CEO and the company. Who is the CEO of the Apple? Not Steve Jobs anymore. Yes, exactly. So suppose that we have shares of Apple, but we don't know what the CEO of Apple is doing as of now. Like probably, what time is it in New York? 11 a.m. If the weather is nice, probably he's playing golf or something, right? We don't know what they're doing. So that's one problem between us and the managers. The other couple of examples, there is green mail, or the poison pills. So we know that if a company is not managed well, then it can be a target for an acquisition. We talked about takeover defenses last week. Actually, no, the Tuesday. We talk about those. So if a company has some kind of green mail, it might pay the acquirer actually not to buy the company, for instance. So it's almost like blackmailing, but the legal version of it. So they can, this is also conflicts of interest between us and the managers. So for us, we want the company to be managed well. For the CEO, he wants to keep the job. So that's another problem. The CEO can use other anti-takeover devices like poison pills and stuff to avoid the takeover. Again, for us, takeover is good. For them, it's not. So that might create conflicts of interest. Golden parachutes, I don't remember whether we talk about it. It's basically very lucrative severance packages that CEOs get even if they're fired from the company. So you cannot even get rid of them, even if they're really, really bad. Or even if you do, they get a ridiculous amount of money. So I have some examples about it later. The last example I have between for the agency conflicts between shareholders and CEOs is the empire building. We talked about it last time. The CEO might be over-investing and spending all the money to make the company as big as possible. And the question that I'm going to ask you is, why do you think a manager wants to manage a bigger company?
So that he can pay.
Yes, studies show that large companies pay more to its CEOs. Perfect. What else? Reputation, exactly. They want to be known. Of course, the bigger the company is, the better it is. Do you have anything else? Or? Greed? Oh, okay. Yeah, it's also managerial characteristics. Not all CEOs are greedy, probably. I don't want to say anything bad in front of cameras. Probably not all of them are greedy, but you need some kind of, what's a positive word? Not greed. Greed is something negative. Ambitious is good, yes, and persuasive, let's say. So they go after what they want. So you need specific characteristics to be a CEO, of course. I have a couple of examples here, and I'm using academic papers to give you examples. One is a study by Jensen. He looked at whether there's overinvestment in the oil industry, and he saw that after oil prices decreased in mid-1980s, the oil companies continued to drill for oil even if it was a bad decision for the company. So they just continue to grow and expand just to do the investment. In 1993, he wrote another paper, and he showed that in many cases, shareholders would be better off if CEO wasn't making any investments anymore and then paying cash to shareholders, for instance. So overinvestment might be a problem. Another problem might be actually underinvestment. So the manager might be investing less than optimal, and it is actually a conflicts of interest between shareholder and debt holders. And we talked about this before, probably you don't remember, but especially if the investment is done by using debt, then the shareholders might be better off if the investment is not done. Because when the investment is done, then they have to pay some money to debt holders, and they will have less value for themselves. So underinvestment might be another problem. But it's between shareholders and debt holders. Okay, so it is, that was overinvestment. So in order to make managers act more in line with shareholders, the first mechanism that comes to mind is probably board of directors. Board of directors are elected by shareholders, by the votes of shareholders. And especially in the United States, they have the duty to protect the interests of shareholders. In the other companies in Europe, that might not be the case. I mean, of course, they have some weight on board of directors protecting shareholders, but they also protect other stakeholders in the firm. But in the US, it is almost only for shareholders, okay? And the problem with here is a 1992 survey. It's very old, but it's still the case is still valid. Korn Ferry revealed that 75% of companies relied on recommendations from the CEOs. So you think that you're electing the board of directors, but no, it's actually the CEOs picking people for us. Why? They're more informed about the CEO market, for instance. They know people better. Well, one problem with the board of directors is the directors have only a little bit of ownership in the company, almost none, but now they're increasing ownership. If it is the case, directors' interests might not be in line with shareholders because they're not shareholders in the company. So they might not be monitoring the company as good as they should do. So that's one problem. Let's just skip this. An important thing with board of directors is actually there are three types of directors. One is inside directors. These are the people who are employees or former employees or family members of employees. They're great directors. They're not related to the firm directly, but they have some kind of business relationship with the firm. But the most important are the outside directors or independent directors. These are not employees of the company. And actually, these are the ones who should monitor the CEO in the best way possible. Why? They're not employees of the company. They're independent. Since they're independent, they should have a say on things more easily, let's say. Okay. Studies show that if companies have lots of outside directors, then in those companies, CEOs are fired more frequently if there's poor performance, which is good for corporate governance. If you're bad, outside directors are following you. That's important. And independent boards with lots of independent directors, those companies have less value-destroying acquisition, which is also good, in line with the shareholder interest. And also, whenever there's an announcement of an independent director in the company, shareholders react favorably. So it also means that shareholders put some value on having an outsider because they believe that those outsiders will protect their claim, their interest, which is a good thing. Okay. After 2002 regulations, SOX regulation, they required firms to have most of the directors to be outsiders, which is a good thing. They're trying to increase governance in the US companies. And also, if there are lots of independent directors in the board, it affects CEO turnover in a good way. It affects executive compensation decisions, and we're going to see how important compensation packages are. There's less incidence of fraud, which is good, and there's less incidence of opportunistic timing of stock options. And I'm going to explain these in detail in the second hour. Okay, so board independence is good. There are two problems that comes to my mind with this. One, since they don't have equity in the company themselves, their personal wealth is not tied to the company, they are not acting like a shareholder because they're not shareholders in the company. That's one problem. And when you look at historical trend, actually more and more companies are giving equity to outside directors, so they're going to be and think like a shareholder, which is a good thing. Before talking about the other problem, let me give you two examples. One is busy directors. Many independent directors sit on multiple boards, and these are called busy directors. And actually, what do you think if a director is busy? What is like a good thing and what's a bad thing? What's the advantage and disadvantage of having a busy director in the board?
For the company or
for the company, let's say.
It's bad.
Okay, why? Why good, why bad?
Okay, it's bad because it's busy and he may not or she may not spend too much time for the company.
Yes.
On the other hand, he has better connections.
Okay.
He knows markets. I mean, he knows.
Okay.
He has more
Same. Okay. Exactly. This is exactly. Do you have anything else? Okay. Completely agree with it. So they have more expertise on different areas, let's say. But at the same time, they might be very busy. And actually, I remember one study, I don't remember who wrote it, but they show that actually if you have lots of busy directors, the firm performance is lower. It's not a good thing for the company. It's what it's shown. Another thing is captured directors. It's basically directors whose monitoring duties have been compromised by connections or perceived loyalties to management. So in that case, I mean, if a CEO is suggesting your name as a director, of course, you will have some loyalty to the CEO. Or another thing is, I give this example all the time, but it is fair. I mean, those people, like think about New York, let's say. Think about people on Wall Street. I mean, those people's kids go to the same school, they go to the same club. I'm talking about like country clubs and stuff. Their wives are friends, best friends. They go to spas together. So they have lots of connections, actually. They're really connected, and they're covering each other's dirt, let's say. So that, I mean, not all of them, but probably this is what we generally see. So if we have something like this, we call those directors as captured. Okay, about information, whether outside directors have enough information about the company, which is actually the second problem I had in my mind. I mean, if you're an outsider, do you know as much as the CEO or the insiders of the company? Probably you say no, right? I mean, you cannot know more than the CEO or more than the insiders, employees of the company. But actually, there is one study, recent study by Ravina and Sapienza. They look at the trading performance of independent directors and other officers of the firm. So basically, they look at how well they bought and sold the company they are sitting in the board and compare it with the CEO trading, let's say, CEO's tradings. If there's informational disadvantage of the outside director, you would see the outside director earning less return, right? But actually, the results are just the opposite. They saw that they are earning positive and very good abnormal returns when they trade on the stock of the firm they are the director of. And also, if they also sit in the audit committee, this is not surprising actually. If they're also in the audit committee of the firm, they are earning higher returns than other independent directors. So, of course, if you're auditing the company, you have to be more aware of what's happening in the company. So you are more informed. That's not surprising. And independent directors earn significantly higher returns than the market when they sell the company stock in a window before bad news and around earnings restatements. Which means, I mean, they know when the information will come, and they can time their information, and they're making good investment decisions when they focus on the stock of the company. So all those results show that independent directors actually have enough information about the company. So they're informed, and they can really protect your stake at the firm. OK, so this is, I think, everything about board independence. Any questions? Yes?
Who chooses the outside directors?
OK, so it might, OK, shareholders vote on the directors, but they generally, the board nominates some names. If not, you can also nominate some names yourself, but probably the name that was already nominated will get more votes. OK, anything else? OK. Let's talk about board size in only this slide. Which board is better, a big board or a small board? What do you think? Which one is more efficient? Huh? Actually, studies show that small boards are more effective, and they are the companies with smaller bonds have increased firm value and performance. And it comes from all the psychology and sociology kind of research. So you're basically more efficient. Believe me, if there are like 50 people with high egos, probably it's not very easy to get some results from that meeting. If it's only 5 people, it's easier, right? I mean, it makes sense. OK, another thing is diversification, let's say. We talked about diversification before in financial terms. Which one is better? What do you think? A diversified board or not diversified board? Like, OK, with diversification, think about women, let's say. Do you think it's good to have women in the board? Because you're diversifying. And we have only like 2 females in the class now. No, 3 females, including me. OK, what do you think? One is enough? I think one is enough too, actually. There's this saying, like, if, what was that? If the countries were governed by females, you would have lots of countries not talking to each other. Like, do you remember? There's like saying like the, no? OK, because this is what happens. Like, we don't enter in wars, but we just stop talking to each other when like you don't like a girl. Kesinlikle, kesinlikle. Yani hani öyle bir şey var. Keşke bunu bir dahaki slayda koyayım kesin. OK, so actually it's better to have women in the board because, according to the study, female directors have better attendance records than male directors. And when there's more females in the board, males also start going to the meetings more. And women are more likely to join monitoring committee. Like, we just sit there and judge, OK? So we are good at that. Another thing is, actually, they look at religion and all other kinds of things as well. Overall, having a diversified board is a good thing. More ideas, let's say, different backgrounds is good. have finance people, engineers, and I don't know, like all marketing people, lawyers in the board. It's the best case because everybody has a different expertise. But if you look at US, only like 4% of CEOs are African American, Latino, or Asian, and only 2.4% are female. Percent of the CEOs are female. It's not very good, actually. And among US directors, 30% have worked abroad, 9% were educated abroad, 7% are foreign-born. So in American companies, we see American dominance still. I don't think it's going to change much. But again, diversification is good. And probably you know, there's this Turkish CEO of a very important company, US company, Muhtar Kent. Like maybe one of you will be the second Muhtar Kent. We don't know. Okay. Okay. So these are about the directors. And I'm going to spend a lot of time talking about what CEOs make. Neydi öyle bir şey var ya, fakir, ne? Zenginin malı, fakirin zürünçe. Okay, this is what we're going to do. Okay, we're going to talk about compensation packages and stuff. So I like that topic a lot. And you will be interested in how much those people are making for your career options and stuff, right? Okay, so when I say compensation packages, first of all, there's a compensation committee in the board. They decide on the compensation of the CEO and of themselves. And in many cases, CEOs also sit in the compensation committee, so he determines how much money he's going to make with his friends in the board of directors. And in the compensation package, we see a fixed salary. On top of it, they have the stock options. And one case is about the stock options, actually. That case is very, I think the name is Sarah's option, that case. It is really detailed, really, really detailed. You don't have to go into detail that much, but we're going to learn about compensation more. Who is doing the compensation? Is it your case? Okay, yes. So you're going to explain us about the compensation packages. So on top of the salaries, there's stock options, there's pension funds. I don't know, they have like tens of different items in their compensation package. Okay. So in 1993, for instance, the average CEO was making $200,000, which is less than what a finance professor does now in US. But it increased to 1 million in 2001. So they're making, 1 million is nothing for them, actually. But this is the median value of all the options granted. And the companies were using options and grants a lot. But recently they started decreasing it. So what it is actually granting options. So remember, we talked about options before. And we know that if you have a call option, increased stock price is a good thing, right? If the stock price increases and when you exercise your option at an exercise price, whatever it says, you're going to pay the exercise price, but in the market, the price of the stock is high, which is awesome. So for the CEOs, the companies give those kind of stock options, and when the stock price increases, then the value of their stock options will increase. So we are trying to tie performance of the company to the compensation, right? Because they're already getting a fixed salary. But on top of it, we want to give them more incentives, so they're going to work for us. And for us, increased stock price is good. So with those options, they can increase their compensation. But I'm going to show you all the problems related to that later, after the break probably. So this is the CEO compensation from 1993 to 2007. As you can see, there is the cash part is almost fixed. For the options were used widely in the beginning of 21st century. It started to decline again because of a scandal we saw. And I'm going to talk about the scandal later. And there are other parts of compensation as well. Okay. One example of how much money the CEOs are making, this is for hedge fund managers. This is for the top 25 hedge fund managers in Wall Street. The money they are making is, as you can see, like, I mean, there are lots of them which made more than $1 billion. Some of them made less than like $100 million as the fund, let's say. But even if they have a bad year, their salaries don't change that much. So those hedge fund managers are perfectly skilled. They have PhDs from top schools, very clever guys. And if you remember, hedge funds are high-risk portfolio management. And like, I cannot buy a hedge fund, for instance. Like the cheapest one is probably like $25,000, $50,000. So they are doing high-risk investments, and they're making tons of money. And if you, I'm not going to open this article, but if you open it, basically they say, oh, I wish you didn't put us in this list, because when you do this, it's bad luck for it. This happened in the past, and we were on the news, and then next year we couldn't make as much money. But they are basically making ridiculous amount of money. Their compensation packages are really, really high. When you want to tie the performance and the pay of the companies, I'm going to give examples from two studies. One is if the firm value increases by $1,000, the CEO pay will change by $3. It might sound like it's not very high, but we're talking about like $1 million worth of investment. And if you increase the value of the company, your pay will also increase. In 1998, Holland Liebman found a little bit a different result. They found that if the firm value increased by $1,000, the CEO pay will change by $5. Again, it might not sound much, but it is a lot if you're talking about $1 million worth companies. Okay, so let me just talk about a few more things, and we're going to take a break. So in the compensation, when I say compensation packages, there's also some perquisites related to being a manager, being a CEO. Like what? They have their own private planes. They have unlimited spending on food and even clothes and everything. So we're not just looking at the salary, but even those are increasing the compensation package a lot. Yermak had a study, and he looked at the use of corporate jets by the CEOs. And actually, they show that in the companies where CEOs are using corporate jets, actually shareholder value is decreased. So those are the CEOs who are ripping off shareholders, actually, which is in line with the characteristic of the CEO, right? If the CEO is using the corporate jet to go to Alps for skiing, not corporate event, then of course it means this guy is very greedy and probably he's going to do bad things. I don't know whether, I mean, we see those kinds of things in Turkey as well. If you're an executive, you have the company car. I remember, like, my dad never used the company car for, like, holidays, let's say. Like, we never used the company car to go on holidays, like, even if the gas was free. But normally this is what people would do, right? It talks about, it really tells a lot about the personality of the CEO. Another thing is Agarwal, Meche, and Wang, they looked at corporate political donations. In US, companies donate money to corporations, and it's legal, and it's publicly known. Like, I don't know, if you're an oil company or tobacco company, you're going to donate lots of money to Republicans or Democrats? Republicans, of course. So, and this study showed that it is, if companies are doing lots of corporate political donations, these are the companies where CEOs care about themselves, not the shareholders. Again, the idea is same. Those are people who are knowing the ways of industry, let's say. So that might be another problem. Okay. One thing about the CEO compensation and how it is affected, there are studies which show that CEO pay is higher when outside directors serve on multiple boards. Again, I mean, they're busy, they're not looking at the CEO compensation probably. When more of the outside directors have been appointed under the CEO, the same problem, the CEO elected those people and they don't care about the compensation of the CEO that much. When there are no large outside block holders, why do you think it's the case? Why is it good to have a large block holder? Large block holder means like a large shareholder has more than 10% of the company.
Speculations.
Something easier. So, huh? And who is gonna?
More say in the company.
Yes, and he's gonna be more informed about the company. Like for us, we're not gonna know that much, but if we own 10% of the company, we would know everything about the company, right? So if there are no large outside block holders, lots of small shareholders, then the CEO compensation is higher. When a smaller percentage of shares is held by institutional investors, what is this, institutional investors? Give me an example of an institutional investor. Huh? Okay, I was talking about the general. Yes, pension funds is another example. Mutual funds, hedge funds, these are big institutional investors. So if you have the same problem, if you have big institutional investors, then there will be more monitoring because they have more stake in the company. If it's not the case, then the CEO compensation will be higher. And the last one is about mergers. When there are lots of anti-takeover protections in the company, the CEO compensation is high. So these are all examples of corporate governance, actually. Okay, so these are almost like poorly governed companies. Because of that, we can say CEO compensation is higher. Okay, let's just stop here and take a 10-minute break, and then we're going to continue.